We have looked into every factor, every indicator, and under every rock. We have our conclusion. Central banks have created the everything bubble. What we have not collectively come to terms with is that this will eventually end. Most heavily invested individuals refuse to admit the severity of the damage that a central bank induced bubble can become. Weakness is shown in many factors and can persist, like with earnings. But wait, earnings are being reported as good. What's the problem? You came here for the truth, so let me unveil that for you. Despite the fact people don't want to hear that line, it will persist, just like what we're seeing with the current crisis we're dealing with today. Now, I am going to bring you the chart GPS, but before that, I wanted to get into what's happening with earnings because I think that this is something that they will not touch on. And what I need to say up front is that you look at the earnings that you will see reported every single time, always pushed up by what they're doing with the corporate buybacks. The stock buybacks are happening, and that in fact makes each and every stock look better. Now you have to think about this for a second. You have a central bank, lowers interest rates and prints a bunch of money. You have individuals out there seeking yield. And what do? They buy corporate debt. They are buying riskier assets. You're looking around the world and you see the same things happening, but it is extremely evident in the United States. What I tend to find right now with the US is that all of these major corporations, the big ones, they are buying back their own stock at a record pace. This has been going on for several years. It's been going on for quite a while before that, but over the last few years, stock buybacks have been the number one reason why these individual stocks have done very well. If you look at the stocks in general that are doing stock buybacks, they will perform better than those that do not do stock buybacks. It is very clear. At the same time, we have already documented this many times before, but essentially looking at the insiders, they do a stock buyback that pushes the stock price up, that looks great for earnings, okay? And then they sell some of their shares at that moment. Doesn't that seem interesting to you? Now, they're not selling all of their shares, but certainly they know exactly what's going to happen and they're able to profit while more and more people come in at that time. They might not want to buy any shares. They might just hold on to their shares, but as they are going through this stock buyback period, they know when it's coming, they know how to do it, and they sell at the appropriate time. This article out of Bloomberg had some information I wanted you to know. Companies in the Nasdaq are headed into earnings season with momentum that approaches the unprecedented. Their value up by more than $1 trillion since October. Now the world finds out if the rally made any sense. So we always have this occur where the stocks may go up and up and up, and then we get the earnings reported. But like I said, you have stock buybacks going on that is affecting this. They don't care about that. As long as it looks good on paper, everything's good. And if and all fails, we have some problems, don't worry because the Fed will be there to print more money to ease the pain. 26 constituents are due to report quarterly results next week, including 3 of the 4 biggest US companies over one blistering 48-hour stretch. Because of how hot these stocks have been, it is estimated that the investors may be not willing to accept any little bit of weakness. They're going to look for an opportunity to sell off a few shares to take the profits that they have gained so far. As things stand now, Nasdaq stocks are perched at the highest forward valuation since 2007, and investors are getting progressively less patient with failure. Already this reporting season, companies in the broader market whose sales and earnings trailed analyst estimates have seen their shares pummeled the next day by the most in 5 quarters. The market isn't going parabolic, but some of these tech stocks really have. If you miss the bar, you're going to get punished, no question about it. And this is coming from Charles Schwab. The latest leg of the bull market has come at a time when overall earnings have stopped rising for most industries. The reason valuations have swelled so much. While the index rose every quarter of 2019 in terms of price, profits fell in 2 and are now forecast to contract in the third. Given the Nasdaq surge 38%, investors have obviously been okay looking past those numbers. That's when you know that we have these overvaluations taking place, that investors simply overlook everything. Well, don't worry about it. The Fed will be there. Well, don't worry about it. Stocks have gone up. They use any excuse, but ultimately we are trying to actually analyze the data. No growth? No problem. Tech stocks have been rising despite falling earnings growth. You could see at the top, the S&P 500 Technology Index earnings growth looked very weak throughout 2019, despite the fact that the stocks just went up like a rocket. S&P just can't catch up. Tech stocks have rallied twice as fast as the S&P index since 2019. We have watched all of these different stocks, the tech stocks in particular, rising very high. And if you could believe it or not, those FANG stocks, those tech stocks have done even better than the market itself, which had performed incredibly well over that period. Stanley Druckenmiller had this to say. It's within this article, but I just wanted to cover this one point. He's talking about the potential risks, the potential issues, not just for 2020, but beyond. One of the things we have to watch is a credit event. And if you look at the credit markets, it is very obvious that you've got a really lot of bad apples out there, and they're not being exposed because the interest costs are so low. By the way, one of them being the US government. We're running $1 trillion deficit. Why? Because we can. Just something to think about, some food for thought as we move into this, coming from Guggenheim. And I wanted to show you the 10 macro themes to watch in 2020. I may not cover all of them in detail. Here's the list right now. I'm going to show you each and every chart. I might cover some more than others, but let's get into it. Household net worth gains will support consumption. On the right-hand side, they're going to give you the few points that are associated with it. You can look at the chart as well. Personal consumption continues to be the main driver of the US economy, helping to spur economic growth in 2019, even with business investment contracting and the manufacturer sector experiencing a recession. So they're willing to put that on paper. I've been showing you that time and time again. Look at the ISM data. Look at the PMIs I just showed you yesterday, all looking very weak. Europe, China, and the US, basically everywhere, we're seeing the same trends. The purple line here, assets to personal income, has definitely grown over the last few years, and the liabilities to personal income, that's the blue line, that's come down, still at 100%. Low rates will underpin housing despite valuation concerns. We expect the housing market to contribute positively to US economic growth. Of course, with these extremely low interest rates that we are seeing and the potential that they will even decline further, that is going to be very beneficial to real estate. It only blows the bubble even bigger. It only stretches the debt that people have further and further, burdening them. But in the short term, hey, it's all good. At the bottom, the rebound will be limited as high home prices are denting home buying perceptions, offsetting some of the benefits of the lower mortgage rates. Historic inequality will fuel support for unorthodox policy proposals. This is a chart that I've shown you many times before. Share of national net worth by percentile groups. The purple is the top 1%, the blue, the bottom 90%. That top 1% group owns everything, and I don't think a lot of people realize, even if they're within that top 10% or the top 20%, they feel wealthy because they own some shares of Amazon. Maybe it's 7 shares, for example, but they do not understand what's actually going on. Second point shows you that income inequality is at a multi-decade high, essentially saying that this will foment, this will build, and big changes could potentially happen in a relatively short period of time. Consumer confidence will hinge on the health of the labor market. Conference Board Consumer Confidence Index year-over-year change. Confidence is below last year's level despite a 28% stock market rally. That shows you something is really going on right now. In the fourth point here, you could see that it says, for confidence to rise from here, the economy will need to create jobs at a faster pace in 2020, which seems like a tall order given a fading fiscal impulse and an unemployment rate at a 50-year low. Essentially, we need to see unemployment stay where it is, and if anything, go downward, which is certainly possible the way that they manipulate the numbers, and the jobs numbers need to consistently be coming out very good. We also need to see the GDP growth happening too. That's not looking good, but they can always make sure that it stays at a reasonable level as long as they continue to pad it as they have done. The Fed's soft landing theory will be tested. 2-year change in the US unemployment rate in percentage points. Third point says, we expect that momentum in the labor market will continue to fade with economic growth near potential and further labor market gains constrained by limited slack. Credit rating downgrades will add headwinds to business investment. This is Moody's upgrades and downgrades for US investment grade and high yield credits. Something that I talk very often about is the corporate debt. We get all of the different derivatives that are out there. None of them are very good as far as I'm concerned, but they're all connected to this debt. If we have downgrades, it's going to be a problem. And of course, if there is a crisis, we're going to see downgrades. That's going to create a cascading effect. The gray areas are the corporate downgrades, and you can see that fourth quarter 2019 wasn't looking good at all. As they say here, the fundamental picture for corporate credit worsened. And why? We've got interest rates at extremely low levels. We've got a bull market in stocks that never seems to cease. Same thing with real estate. Business conditions are supposedly fantastic. Why isn't everything doing well? Well, of course, we have the cracks in the foundation that are appearing. Weak earnings growth and continued increase in leverage has resulted in more credits being downgraded than upgraded by the ratings agencies. I want to see what's going to happen this week and beyond. I think it's going to be really important. Corporate defaults will rise as debt burdens weigh on credit. Second point, today's corporate credit markets include more below investment grade rated debt and more BBB rated debt than ever before. And as I said, as soon as they get downgraded, we're going to have big problems. And of course they will. The only question is how long that will take. A tight labor market will further depress corporate profit margins. At this point, I'm not even sure that the investors really care about profit margins. I know the businesses don't care. They'll burn through money as much as possible, and people will throw billions and billions of dollars at them. But regardless, the pace of the Fed balance sheet expansion will slow. And I could agree with this, at least for a period of time. Maybe we get to April, they slow this down, they don't buy as much of the debt because they want to make it seem like everything is okay. So they can slow that pace down. But their balance sheet needs to expand over a long period of time. Once they started that quantitative tightening policy, it was only a matter of time before they had to reverse that. That's where we're at today. The points on the right side are essentially covering what we have so many times before. I won't read them all to you. The Fed did too much quantitative tightening, at least more than the market was willing to handle. Is it QE? Is it not QE? The balance sheet will grow, but at a slower pace. And also wanted to note the fact that some analysts out there do believe that they will have to go and outright begin real, quote unquote, real QE4 at some point, switching over from the very short-term debt into longer-term debt. But one of the factors here is that they've been buying so much of it, there's not enough coming up on a daily basis for them to get in there as much as they need to actually keep the rates where they're at, to actually accomplish the goals that they have. This is how crazy this system is, because you're trying to manipulate it on every single level. That would be fine, but there's some sort of natural forces at play too. They can just take care of everything, take over the entire industry. Why even open the markets anymore? Just print money and throw them right into everybody's account. I really don't know what the hell is going on today. Everything is a mess, but nobody seems to care anymore. So I want to thank you if you've stuck with me this long. Really, really appreciate all of your kind words. I want to thank you all for the responses on the poll on my community or blog section of the channel. Thank you. If you want to support me, just hit the thumbs up. I really want to thank you for that. If you want to learn about e-commerce, if you want to learn about online business, I created a free course for my subscribers, teaches you every step of the way, the AmazonGPS.com. If you want to know about the financial industry at a deep level, but not have to deal with any of that jargon, any of the garbage that gets in the way, these two books will do that for you. I wrote them specifically so that anybody, whether they have experience or not, will be able to understand what's actually happening. Check them out at the link in the description. If you want the audiobook, moneygps.com. So you want the how-to and the solutions? Well, I got this playlist right here. It's called How To and Solutions. Click on that and I'll see you there.